In the world of cryptocurrencies, there's a crucial distinction between holding assets through an ETF and actively staking them to earn rewards. Currently, ETF holders miss out on these stake rewards, creating a potential dividing line in the market. While initial approvals for crypto ETFs may be on the horizon, widespread adoption might still be some time away. The existence of futures markets for cryptocurrencies suggests that ETFs could eventually follow suit. Whether this trend will extend to other asset classes remains uncertain. In the medium term, it seems likely that we'll see more ETF options for cryptocurrencies, although this isn't an area I closely track compared to others in the industry.
In the evolving landscape of cryptocurrencies, there's a notable distinction between holding assets through an ETF and actively staking them to earn rewards. Currently, ETF holders do not participate in staking rewards, which are incentives given to those who contribute their assets to support the network's operations. This dynamic has become a significant point of discussion and could potentially shape investor preferences in the future. The prospect of a cryptocurrency ETF has been a topic of interest for some time. While there have been discussions and some initial steps towards regulatory approval, widespread adoption may still be a way off. The presence of futures markets for cryptocurrencies, such as Bitcoin and Ethereum, has laid some groundwork, suggesting a pathway for ETFs to follow. ETFs offer a more traditional investment vehicle compared to direct ownership or staking. They provide a way for institutional and retail investors to gain exposure to cryptocurrencies without needing to manage the technical aspects of staking or holding digital assets directly. However, the absence of staking rewards in ETFs could be seen as a drawback for those looking to maximize their returns through participation in blockchain networks. Looking forward, the trajectory of ETFs in the cryptocurrency space remains uncertain. It's possible that initial approvals for Bitcoin ETFs could pave the way for other cryptocurrencies and even broader adoption across different asset classes. The regulatory landscape plays a crucial role here, influencing how quickly and widely these financial products can be introduced and accepted by mainstream investors. For now, while ETFs offer a convenient entry point into cryptocurrency markets for many, those interested in the full benefits of blockchain technology, including staking rewards, may continue to explore alternative investment strategies. As the market matures and regulatory clarity improves, the intersection of ETFs and staking rewards could evolve, potentially reshaping how investors approach digital assets in the long term.
Subscribe our channel and press the bell button to get our video notification. And like the video.
Over time, I've noticed a shift in institutional understanding and media coverage regarding digital assets like Bitcoin and stablecoins. Institutions and financial media are increasingly recognizing their potential amidst current fiscal challenges. These digital assets are seen as tools that can either provide solutions or disrupt existing systems, depending on one's perspective. This evolving awareness reflects a growing recognition of their relevance in addressing macroeconomic issues. As someone who's been involved in these discussions, I observe a trend towards greater acceptance and consideration of these assets' role in the broader financial landscape.
Over the years, I've observed a notable evolution in how institutions and the financial media perceive digital assets like Bitcoin and stablecoins. Initially, there was skepticism and uncertainty, but gradually there's been a growing understanding of their potential benefits and challenges amidst our current fiscal environment. Institutions, through ongoing dialogue and analysis, are increasingly acknowledging the ways in which digital assets can offer solutions to macroeconomic issues. For instance, Bitcoin's decentralized nature and finite supply provide a hedge against inflation and currency devaluation, factors that are increasingly relevant given global economic uncertainties. Similarly, stablecoins, which are pegged to stable assets like fiat currencies or commodities, are gaining attention for their potential to streamline cross-border transactions and reduce costs in the financial system. This efficiency can be particularly valuable in times of economic volatility and geopolitical tension. The media landscape has shifted as well. There's been a gradual shift from outright skepticism to a more balanced exploration of how digital assets can impact financial markets and economies. This shift reflects a deeper understanding of the underlying technology and its potential to disrupt traditional financial systems, offering new avenues for investment and financial inclusion. It's important to note that this evolving perception is not without its challenges. Regulatory scrutiny remains a significant hurdle as policymakers navigate how to integrate these innovative assets into existing frameworks without compromising financial stability or consumer protection. Looking ahead, the trajectory of digital assets will likely continue to be shaped by ongoing developments in regulation, technological advancements, and market dynamics. As institutions and investors navigate this landscape, there's a growing recognition of the transformative potential of digital assets, tempered by the need for responsible adoption and regulatory clarity to ensure their sustainable integration into the global financial ecosystem.
Investors have numerous options that have shown strong performance competing with gold. For instance, there's Bitcoin, including recent Bitcoin ETFs, which have attracted significant attention. The S&P 500 index has also been a robust performer, as have individual stocks like Nvidia. These alternatives have outpaced or kept pace with gold's performance, offering investors diverse avenues for growth. Comparatively, gold's performance against Chinese equities or movements in the yen tells a different story. Chinese equities have shown varied performance influenced by domestic policies and global market sentiment, which can diverge from gold's price movements. Similarly, fluctuations in the yen can affect gold differently due to currency dynamics and geopolitical factors. While gold remains a traditional hedge and store of value, investors are finding compelling opportunities in assets like Bitcoin, equity indices, and individual stocks, each offering unique growth potential in today's dynamic market environment.
Investors today have a plethora of alternatives that have shown robust performance, rivaling or surpassing gold. One standout is Bitcoin, which has garnered significant attention, especially with the introduction of Bitcoin ETFs. These vehicles provide easier access to Bitcoin for traditional investors who may have been hesitant to navigate the complexities of cryptocurrency markets directly. Bitcoin's appeal lies in its decentralized nature and finite supply, qualities that some view as offering a hedge against inflation and currency devaluation, similar to gold but in a digital form. Beyond Bitcoin, the S&P 500 index has consistently delivered strong returns, reflecting the performance of large-cap U.S. stocks across various sectors. Investors also look to individual high-performing stocks like Nvidia, known for its dominance in the semiconductor industry and growth potential driven by advancements in artificial intelligence and gaming technology. When comparing gold's performance against other assets like Chinese equities or the Japanese yen, the picture shifts. Chinese equities can be influenced by domestic policies, regulatory changes, and geopolitical tensions, factors that can diverge significantly from gold's price movements tied to global economic sentiment and inflation concerns. Movements in the Japanese yen against gold can fluctuate due to currency dynamics and Japan's economic policies. These factors highlight the nuanced relationships between gold and other asset classes, underscoring the diverse investment landscape available to today's investors. While gold remains a traditional safe haven and store of value, investors have increasingly turned to alternative assets like Bitcoin, equity indices, and high-growth stocks for their investment portfolios. Each of these options offers distinct advantages and risks, reflecting the evolving preferences and strategies of investors in navigating today's complex global financial markets.
Subscribe our channel and press the bell button to get our video notification. And like the video.